Thank you very much, Jens, for again our strenuous hike. Very illustrative, very exciting, and thank you very much, Guillermo, for your remarks. So I'm sure that my four colleagues in this panel, Haruhiko, Pablo, Lesetja, and Thomas, have been inspired by the brilliant speech provided by Jens. Needless to say, very well chosen and very well argued. So the way we will operate this panel is each one of my colleagues will have 8 minutes to give reflections on the general topic that was addressed by Jens. Then I might ask 1 or 2 questions to them very briefly, if time permits. If not, I will privilege the dialogue with the floor, where you will be able to ask questions to the panelists, but of course also to Jens. So without further ado, let me give the floor to Haruhiko. Please, Haruhiko. As you wish, here or there. You have your microphone, so you can can even walk in front of us.
Thank you, Agustín.
Okay.
It is, of course, a great privilege to speak at this event. Since we last met in Basel at the annual general meeting in 2019, uncertainties certainly have heightened dramatically due to, for instance, the pandemic and Russia's invasion of Ukraine. In this context, I would like to talk about the acceleration of structural changes, focusing on 3 areas and its implications for the economy and prices and, of course, monetary policy. The first area is the possible retreat from globalization due to geopolitical risk. Over the past several decades, the global economy has benefited from the broad aspects of globalization, such as trade, competition, and supply chains. This international system has been built up by close cooperation and coordination among countries and the active role of international bodies, including BIS. Globalization is often said to have contributed to the downward trend of prices, for instance, allowing firms to produce and sell goods more efficiently. If globalization recedes, always being equal, this trend could be reversed and inflation expectations could be pushed up. Meanwhile, rising inefficiencies due to the retreat from globalization could push down the natural rate of interest. The second area concerns the acceleration of digitalization after the outbreak of the pandemic. For instance, the use of e-commerce and digital money has expanded rapidly to avoid physical contact with others. Even after the pandemic is contained, this trend is expected to continue globally. To date, some say that digitalization has likely led to lower prices due to, for instance, cost reductions by firms and easier price comparisons by consumers. This would offset, to some extent, upward price pressure brought by the retreat from globalization. Also, digitalization seems to be bringing a dramatic shift in labor demand across industries, as well as widening income inequality. To cope with this problem, ensuring labor mobility and job training would be essential for smooth resource allocation, although monetary policy may not be the primary tool. Anyway, given the global nature of digitalization, it is important for us to deepen our understanding of its impact on the economy and the prices with due attention to its pace in both domestic and international context. The third area relates to demographic changes. I will talk about this factor today since Japan is a very rapidly aging society. There are various views on the possible impact of aging society on prices. What is important is how to maintain and improve the growth potential. In the case of Japan, since 2010, excluding the period affected by the pandemic, GDP per capita has grown at a high annual rate of around 1.3% on average. This high rate is partly due to the fact that under the Bank of Japan's accommodative monetary policy, firms have powerfully encouraged women and seniors to participate in the labor force, supported by the government's measures. In order to further enhance the growth potential of the Japanese economy, it is necessary to accumulate capital stock and improve its productivity through, for instance, investing in human capital. So far, I have talked about 3 examples of structural changes. All in all, globally, it is extremely difficult to assess the possible impacts of a variety of structural changes on the overall economy and prices. In any case, the mandate of central banks will remain the same. That is to stabilize prices for economic development with our monetary policies, although the policy transmission channel may change in a rapidly changing world with uncertainties. In this regard, past experiences show that central banks can flexibly evolve their monetary policies to respond to a variety of difficult environments. For instance, Bank of Japan pioneered in the introduction of unconventional policies such as the zero interest rate policy and quantitative easing adopted around the year 2000. In the wake of the global financial crisis and the pandemic, most of us proactively introduced unconventional monetary policies. And now, some of us are taking steps toward normalizing the policies. Through these experiences, central banks have also learned the difficulty of understanding the shocks and their persistence at an early stage. We should continue our careful examination of the most recent quantitative and qualitative information and conduct monetary policy according to the economic and price conditions of each country without any preconceptions. Lastly, I would like to emphasize the importance of global cooperation and coordination among central banks. Throughout our long history, we have strengthened our ties and promoted relationship for peer learning. This has served as a driving force for our monetary policies to evolve with innovative features. From this perspective, I think the BIS is definitely an essential home where, just like a family, we can gather on a regular basis and frankly exchange views, even in the current difficult situation with great uncertainties. Let me stop here.
Thank you very much, Haruhiko. Thank you for give us some flavor about what's going on in Japan. I still want to know what is your magic sauce to keep inflation permanently under control. Many of us might want to have the recipe. So now, Pablo, the floor is yours.
Thank you very much, Agustín, and thank you and congratulations, Jens. Excellent speech as usual. By the way, very deep and very clear. So let me start maybe with the obvious. It was emphasized by Jens, also by Haruhiko. One of the most salient features of the world economy over the past 3 years has been, of course, the occurrence of several shocks, tail events, that maybe together with some structural changes, some of them related to the tail events, other not, probably they were already there before those shocks, have led to a significant increase in uncertainty. And we have seen very clearly this increasing uncertainty, for example, all measures of economic policy uncertainty, geopolitical risk are on the highest levels in 15 years. Perhaps more important for us is the fact that this uncertain context has filtered through to economic forecasts. As a way of illustration, if we look at inflation, for example, inflation in the euro area, the standard deviation of the inflation forecast surveyed in the consensus panel of analysts is at historical heights. The same, we can observe the same thing with inflation expectations of households, and I guess that the increase in the risk premia that inflation expectations as measured by markets, which has been also very significant, it's also another indication of rising uncertainty about future inflation. So I will try to focus in my remarks on two things. First, where I find the main sources of risk in the near term, and then I will also make some comments on how I think monetary policy should face this uncertainty. On the main sources of risk and uncertainty for monetary policy, I guess the first and probably the most important source of uncertainty will remain, in my view, both the size and the nature of the shocks, and perhaps even more importantly, their economic effects and the persistence of these shocks. It was mentioned by Claudio this morning. No? Given the accumulation and the scale of the shocks, there is a clear possibility that some of these effects might become non-linear. And I will illustrate this aspect with an example that has become particularly relevant in the current context, which is the uncertainty about the potential size of second-round effects of the current inflationary episode through wages. Again, let's take the example of the euro area. Wage indicators show very moderate current and expected nominal wage growth. And this is indeed the fact that this will remain is one of the assumptions behind the convergence of inflation to levels close to our target in the medium run. And underpinning this assumption is the fact that the use of wage indexation mechanisms across Europe is currently very, very low, is very, very limited. Of course, the big question is to what extent this is going to change if the persistence of inflation remains. And here, let me take the example of Spain. Spain is a country on which, we experienced a very high inflation environment before the global financial crisis, where inflation was higher than the average of the euro area. So we had a positive inflation differential. And in that context, in the wage indexation clauses were very, very common. Around 75% of our workers were affected by these automatic indexation clauses. In the last 10 years, inflation was low. It was even lower than in the euro area average. And as a result of this, of course, wage indexation clauses also declined very, very rapidly to around 15%, this 17% compared to this 15% in the case of, in the year, for example, 2021. The interesting thing and the worrisome thing, of course, is that this percentage has increased to around 30%. So it has doubled in just a few months in 2022. So I guess this is a potential example of these non-linearities. Another potential non-linearity that I think could affect very much the dynamics of inflation going forward is about the frequency of price adjustments. And here Claudio was also very, very clear this morning. We know that the available evidence for the euro area, which of course was collected in a context of very low inflation, is for low frequency of price adjustments, combined with relatively large adjustments driven mainly by firm-specific shocks. So basically, aggregate shocks didn't play a role. However, there is already preliminary evidence also for the Spanish case, but I guess also for other European countries, that the significant increase in inflation observed in the last few quarters might be leading to a higher frequency of price adjustments, thus increasing the pass-through of the shocks to consumer prices. And this is also important, these price adjustments might currently be more closely related to the aggregate shocks, so this co-movement that Claudio was also emphasizing this morning. So of course, if these potential changes in wage and price reactions, if they are confirmed, this would undeniably have an impact on the parameters of the Phillips curve. leading to uncertainty regarding its slope. Of course, more frequent price adjustments would lead to a steeper curve, but also uncertainty regarding the calibration of the parameter for expected inflation, or even to question what is the relevant expectation measure that we have to use. So this is one source of uncertainty. The second source of uncertainty is the one related to structural variables. And this was mentioned by Jens, also by Haruhiko in their remarks, such as the natural rate of interest, potential output growth, or trend in inflation. Well, focusing, for example, on R-star, well, until very recently, there was a broad consensus that the decline in trend productivity growth, demographic factors, and also persistently higher demand for safe and liquid assets had contributed to lowering the real equilibrium rate of interest, and the economic estimates that were available, for example, for the euro area pointed also into this direction. Many of the elements that have been put on the table by Haruhiko and Jens, well, may change some of the dynamics of the natural interest rates. I have to confess that in my view, it's too early to say that these factors will change completely, and the low equilibrium interest rates that we have experienced. Let me just put one example. The demand for safe and liquid assets might even increase as a consequence of the latest crisis, in a setting on which private, but in particular public debt, has increased dramatically during the last 3 years. But in any case, we have to accept that the level of uncertainty is now higher, and in particular because the pandemic strongly influenced at least 3 processes of structural change that have a major impact on these variables, namely digitalization, globalization, and the transition towards a greener economy. And of course, this uncertainty comes on top of the usual uncertainty that estimating unobservable variables always involves, and in particular in a real time setting. And well, I guess Athanasius is here. He already provided us with a lot of evidence on how difficult it is to estimate potential output growth, and therefore the output gap in real time. The third, and maybe we are not putting sufficiently emphasis on this origin of uncertainty, is on the monetary policy multipliers. Some of the uncertainty regarding monetary policy multipliers stems, in my view, precisely from the fact that in a highly uncertain times, the effects of economic policies, including monetary policy, are affected. And there is a lot of literature on this, for example, for fiscal policy, not so much for monetary policy. And we also know that uncertainty increases during policy turning points, like the present one. But if we also incorporate the fact that we have little evidence, for example, on the effects of balance sheet changes on monetary policy transmission, so for example, in the case of the euro area, we don't have any experience of balance sheet normalization, and in the interaction with interest rate changes, I think this is, for me, another consideration that we have to give in the following years to these elements of uncertainty that I was mentioning before. So what are the implications for monetary policy of this increasing uncertainty? Well, Jens was also providing some of the kind of a summary of the theoretical evidence that we have. It's clear that we are a long way from providing this theoretical evidence, a long way from providing a clear-cut answer as to how monetary policy should react. The classic Brainerd attenuation principle states that policy should exhibit conservatism in the face of uncertainty, but at the same time, the alternative strength of the literature, the so-called robust control, points exactly in the opposite direction. My personal takeaways from this extensive literature on monetary policy and uncertainty are, first, that monetary policy should not be paralyzed in the face of uncertainty. Central banks should continue to act preemptively and in a forward-looking manner. Second, that we have to accept that there is no general rule for monetary policy to be either attenuated or more activist in the face of uncertainty. And third, and also very much along the lines that Jens was emphasizing, that risk management approach is crucial. And a risk management approach entails, in my view, pragmatism, judgment. It was a word that was used by Claudio this morning as well. which needs to be based on a critical examination of the evidence and the realization that past behavioral patterns can quickly change. And in this regard, when making decisions in the present, we need to work, and I think we are all working, not only with a baseline scenario, but also with alternative scenarios and simulation exercises that ease the different assumptions underlying this baseline scenario. My personal view of how the ECB, how we are reacting, is in the current highly uncertain environment, is being based to a great extent on these principles. The concepts of optionality, gradualism, flexibility that have guided our policies since September 2021, I think they are a very good example of this approach under the leadership of our President, President Lagarde. So optionality means that we must ensure that we are poised to react effectively to a range of scenarios if they materialize, and that the path of our policy is data-driven. Gradualism, I guess, is a pragmatic approach that is generally suitable precisely in situations characterized by significant uncertainty. However, it is contingent, it is conditional on the data and the inflation outlook, particularly the absence of material second-round effects and medium-term inflation expectations remaining anchored. And lastly, flexibility, I guess, is also a special principle for conducting monetary policy in a monetary union, where the focus is also to ensure that it is transmitted evenly to all parts of the euro area. I will end here. Thank you, Agustín.
Thank you very much, Pablo, for giving us some taste also of Spain challenges, the issue of non-linearities, multipliers, and of course principles that are being followed right now in general terms on DCB. Very interesting. Lesetja.
Thank you very much, Agustín, and thanks, Jens, for your insightful presentation. Well, in the realm of monetary policy, uncertainty is the certainty of the trade. Uncertainty is pervasive in the conduct of monetary policy, and for this reason, judgments are a central feature of monetary policy making. Indeed, as noted by the then Fed chair, Ben Bernanke, in 2007, uncertainty has occupied the thinking of economists and monetary policy practitioners for over half a century. The degree and sources of uncertainty, however, may vary across time and space, and it is its changing nature that challenges central bank policy design and actions. My brief interventions today would focus on 5 issues. Firstly, the current sources of uncertainty. Secondly, modeling complexities and challenges for emerging market central banks. Thirdly, policy error and central bank credibility. Fourthly, the implications of uncertainty for monetary policy decision making. And lastly, the importance of maintaining central bank independence and credibility during this time of heightened uncertainty. Regarding the current sources of uncertainty, we are all firmly aware, and Jens has just reminded us, of the structural transitions taking place worldwide. The new digital era, greening of economies, demographic shifts, and realignment of supply chains broken by the pandemic and the geopolitical tensions. These are structural factors that impact on relative prices and the neutral real interest rate level. These transitions will impact the nature of inflation and potentially the transmission of monetary policy, and in ways that are still not fully clear and a period that remains indeterminate. The question for central banks is, how do we ensure that we are prepared for such eventualities? How do we navigate this terrain to remain credible? And I will revisit these points in a moment. But this brings me to my next point on the challenge of modeling economies amid heightened uncertainty. As uncertainty increases, analytical and modeling frameworks used by central banks will need to adapt. While new techniques for handling these complexities are sure to be developed, emerging market central banks will also need to develop capacity to adapt and operate these frameworks. Most of us in the emerging markets, including my own, still rely on relatively simple macro models to inform policies. And these work well in certain times, but are a challenge in an era of heightened uncertainty. So understanding of the dynamics of the economy is critical for quality policy making. Yet rising uncertainty accentuates the fog around this. Peer learning through collaborations and deliberations, focus on human capital development could help close the technical skills gap for emerging market central banks. Also, over the past 2 decades, many emerging markets have embraced inflation targeting frameworks, and many others are exploring a shift to inflation targeting. How will heightened uncertainty impact the appeal or even political support of inflation targeting if the target becomes more elusive and possibly requiring a relatively higher sacrifice ratio? Let me now turn to the risk of policy error and credibility for central banks. Other things being equal, and they seldom are equal, as uncertainty rises, so will the probability of policy mistakes. Yet, central bank credibility is necessary for the effectiveness of monetary policy. Effective analytical tools and good judgment remain critical components of central banks' arsenals. Models can never be a replacement for judgment. The COVID-19 pandemic provides a good example of innovations in policy analysis. As uncertainty about the trajectory for economies heightened due to the pandemic, policy needed to be made more robust to uncertainty. In response, many central banks shifted from emphasizing baseline forecast to increased use of scenario analysis to enhance the assessment of risks. In the new age of uncertainty, we need new thinking. But this begs the question whether central banks will become increasingly experimentalist in their approaches. While innovation in policy is essential, particularly during periods of high uncertainty, I wonder how unconventional central banks can go before they start to erode their hard-earned credibility. Central banks should also be careful not to fight the previous war when new shocks hit. Ideally, policy innovations ought to be underpinned by sound theory as well as lessons from history to provide a measure of predictability. I would think that policy errors driven by extraordinary uncertainties can, to some degree, be explained away with minimal damage to central bank credibility. However, the same cannot be said of policy errors that impugn on the central bank competence. So, what should the guardrails be? This leads me next to the question of what rising uncertainty implies for monetary policy decision-making. One of the lessons from a Zulu-English war comes from an English general who gave a command to his soldiers and said, "Take aim at your enemy, my boy. Don't pull the trigger until you can see the eyes of your enemy." It is not an option that we have. In Jen's foggy hiking trail, it is not an option that we have. And as I had argued earlier, the risk of policy error increases with uncertainty, implying a higher likelihood of either doing too little or too much ex ante. The challenge is how to calibrate policy in such an environment. Should central banks adopt a more aggressive or a more cautious approach? Put differently, should risks of overshooting and undershooting the target be equally weighted? What would that imply for the anchoring of inflation expectations? It appears to me that the greater the uncertainty about the path of inflation, the firmer the response ought to be. I indeed agree with Jens's point that the persistence of inflation should be overstated rather than understated when its uncertainty is high. Emerging markets generally have a shorter history and hence more limited track record on anchoring inflation expectations. Hence, the risk of brushing off an inflationary shock as temporary and making a policy mistakes are perhaps much higher in emerging markets and probably not an option that we have. While inflation target will on occasion be missed, what central banks cannot afford to get wrong is communicating and being understood both in word and deed that price stability remains our primary mandate. This stance was evident at the onset of COVID-19, where facing heightened uncertainty, the overwhelming consensus amongst us was to immediately take drastic action to avoid an economic catastrophe. Now, as economies have started recovering from the pandemic, central banks are being confronted with elevated and persistent inflation. However, in contrast to the response during COVID-19, central banks have been somewhat slow to act. The lesson seems clear. Waiting to see evidence of inflation before acting often means policy will play catch-up. Central bank credibility may still come to the rescue, but it could actually be easily lost. Finally, I would like to close by saying that defending and maintaining thus central bank independence and credibility during this period of heightened uncertainty will go a long way in navigating a world in which uncertainty is elevated. How can this be achieved? In my view, two things. Firstly, central bank mandates should be kept relatively simple or clear and within the remit of the authority afforded to them. Central banks cannot fix everything, every economic problem. We are faced with structural constraints in many of the economies, and we talk more about them instead of dealing with them. Second, and perhaps more important, transparency and clear and open communication between central banks and the public are imperatives. Independent central banks are entrusted with the public responsibility of maintaining price stability, yet we are not directly accountable to the public. We have to find ways of being accountable to the public. There are different institutional setups in our jurisdictions on how we account to the public. But what we should be obligated to do is to clearly communicate our decisions and actions in pursuit of our mandates and self-accountability. As the ability to provide forward guidance diminishes with higher uncertainty, the role of transparency elevates. Strengthening public confidence and trust in central banks is key. Our independence and ultimately our ability to carry our mandates depends on it. We cannot wait to see the whites of our enemy before we act.
Excellent, very well. Thank you very much, Lesetja. Thank you for the emphasis of all the governance issues related to central bank decision making. Very useful. Thomas, please, now it's your turn.
Well, thank you, Agustín. I'm very honored to be part of this panel. The panel addresses a key issue for central banks at this critical monetary policy crossroad, namely uncertainty. And it was a pleasure to follow Jens's arguments. He is not only a very talented central banker, but obviously also an excellent mountain guide. Now, in my remarks, I will pick up on the subject of uncertainty and explain how our recent decision to tighten monetary policy in Switzerland can be seen in the context of risk management. So let me start with the subject of uncertainty. Uncertainty is always a feature of monetary policy. As Jens has pointed out, some feel that uncertainty is greater today than it used to be, while others do not. Either way, the current situation does have, in my view, two distinctive characteristics. First, inflation. The inflation outlook is unusually uncertain. The inflation effects of the demand and supply shocks triggered by the coronavirus pandemic and the war in Ukraine, as well as of the very expansionary fiscal and monetary policies, are very uncertain. Adding to the uncertainty are the structural factors, many of you mentioned that before, such as the transition to a greener economy, demographics, and the deglobalization. The second characteristic of the current situation is that the exact effects of tighter monetary policy on the economy are especially uncertain too. Markets and central banks have little current data and experience on tightening monetary policy after a long period of very low inflation, very low interest rates, and unconventional monetary policies. Indeed, in many regions, the last tightening cycle took place 15 years ago. Well, against this backdrop, the immediate challenge for central banks is to determine how broadly based inflationary pressures actually are and what the best strategy for tightening monetary policy is under the given circumstances. It is currently difficult to filter out true underlying inflation from headline inflation, as households and firms react dynamically to cost increases. Underlying inflation could suddenly turn out to be higher than expected. The best strategy to tighten monetary policy will, of course, vary from country to country. It will depend critically on the drivers of inflation, the tightness of the labor market, and firms' pricing power. A crucial question in that context is how households and firms respond to the current losses of real income. Now, will employees accept a certain degree of real wage cuts? Will employers partially absorb rising production costs through a decline in their margins? If no one is willing to accept the consequences of the negative supply shocks, there will inevitably be second and third round effects. The likelihood of such an inflationary spiral also depends on the central bank's credibility in delivering on its price stability mandate. This is a crucial determinant of the stability of inflation expectations and ultimately the behavior of households and firms. Let me now explain some aspects regarding our recent monetary policy decision. Last week, we decided to tighten monetary policy by lifting our policy rate from minus 0.75% to minus 0.025%. Now, the inflation situation in Switzerland is still comparatively favorable. Inflation is significantly lower than in many other countries. For these reasons, our move to tighten policy came as a surprise to some observers. So why was there a need for action? Now, our decision should be seen in the context of risk management. Jens has clearly explained to us that in a very uncertain environment, there are reasons for both a gradual and a more aggressive approach. In our case, not an aggressive, but a decisive tightening of monetary policy was warranted. I'm not sure, Lesetja, whether this in your Zulu English classification would be whether we already saw the eye of the enemy or not, but nevertheless, let me explain our reflections. Well, inflation reached 2.9% in May and is likely to remain at this elevated level for the rest of the year. From today's perspective, and assuming that our policy rate remains constant at minus 0.25%, our new inflation forecast shows the rate of inflation temporarily declining to around 1.5% in the course of next year, before rising back to 2% over time. Without our policy rate increase, inflation would be clearly above the range consistent with price stability at the end of the forecasting horizon. This fact underlines the case for a certain tightening of monetary policy. But there are also a few other factors that we took into account for our decision. First, we have had to revise our inflation forecast significantly upwards several times in recent past. The reason for this is that the forecasting power of models is currently more limited than usual, an argument that was also raised by many of you and also this morning by Claudio. In particular, the models do not anticipate changes in the behavior of economic actors well. Indeed, our survey shows that firms are able to pass on higher input prices to customers more easily than before. Furthermore, there is anecdotal evidence that workers' bargaining power is rising in the current labor market. So second-round effects may already be taking place. Second, there is a lot of liquidity in the system. Households and firms have sufficient liquidity to pay higher prices. On the current circumstances, this increases the risk of inflation surprises. Our standard models do not account for this. And third, medium-term inflation expectations, while remaining in the range of price stability, have started drifting upwards. They have moved faster than we expected. Medium-term inflation expectations seems more adaptive than our models assume. All in all, we came to the conclusion that if we underestimate inflation dynamics now, we would have to raise interest rates much faster and to a much higher level later on. This could not only be problematic for the economy, but also carry risk for financial stability. Our experience from the late 1980s and early 1990s shows that that can easily happen. In order to avoid these risks and to take into account our inflation forecast, we have already tightened monetary policy now. A policy rate increase of 50 basis points sends a clear signal that we are prepared to maintain price stability. That said, we may have to do more. Our new inflation forecast shows that further increases in our policy rate may be necessary in the near future. Given the higher uncertainty, we will be observing the developments at home and abroad very closely. Thank you very much, Agustín.
Thank you very much, Thomas. It seems to me that you didn't see the white of your enemy's eyes, but you heard them coming. Okay, well, colleagues, thank you very much. Now let me open the floor. You have 4 extraordinary panelists and a fabulous keynote speaker. So let's start with Pierre, please.
Thank you, great speech and a great panel. I agree with most of what was said. One question for Jens. I'm tempted to say camarade, as we had a lot of discussions in the recent months. But my question is, are we not rediscovering another asymmetry? I mean, we've put a lot of focus on the zero lower bound or effective lower bound in the last few years, which has led our monetary policy to be some kind asymmetric towards this problem of effective lower bound. But my impression from the discussion today and from what Claudio told us is that we've forgotten another asymmetry, which might be much more important. I've never seen deflation of minus 10%. But we are moving into territories of double-digit inflation. So it seems that inflation is not symmetric. It can go up without limits, which is not the case for deflation. But it also seems that the cost of inflation is much higher than the cost of deflation. And I would even dare say, at the end of the day, the effective lower bound, I think, was mostly an academic issue. No governments fell on inflation being stuck at 1%. Governments will fall on inflation going to 10%, and people do care. So my question for you is, as our strategic reviews at the ECB, but I guess in other, maybe Fed and other institutions, were mostly concerned with the problem of the effective lower bound, can we wait another 5 years before having a new review?
Thank you. If you don't mind, Jens, let's take 3 or 4 questions, and then I'll give the floor to the speaker. So, Fernanda and then Libo, and then Jacob.
I think I have the mic, but it's not on. Is it on? No.
Yeah,
okay,
now it is.
Sorry, Agustín, I'll just ask again a question I made on Friday, but slightly different. One of the striking features of this post-pandemic has been synchronicity in counter-cyclical policies. We all went very big and very accommodative back in 2020, both on our business, which is monetary policy, but also on fiscal policies. And then all the economies rebounded together. That was one of the reasons why demand hit supply so fast in some sectors, namely industrial goods, semiconductors, and the kind. But now we are in this phase where we are, again, all hands together, removing the accommodation in monetary policy, not so much in fiscal, but we are all together. Maybe this is also a source of uncertainty that I have not seen mentioned. The fact that we are also synchronized in our policies, although not coordinated, but synchronized, looking into our own countries, but not internalizing what other countries are doing. And possibly one of the main reasons why our models got it so wrong, because we're not internalizing that all the world was doing the same thing together. So I would love to hear from Mr. Weidman what he thinks about this next phase where we are all removing accommodation together. Do you think it could make maybe our actions a little more efficient or potent, since they were so efficient in the first round?
Thank you very much, Fernanda. Now, let me give the floor to Libo.
Thank you. I have a question for Jens and also for the panelists on central bank communication in face of this high level of uncertainty. How to communicate effectively when you have such high level of uncertainty, is it better to communicate the reaction function instead of a one data point? Because we communicate the baseline, but right now the baseline proves to be wrong all the time. And so how to communicate? Are we going to communicate a set of scenarios? Are we going to communicate a reaction function? How to communicate without confusing the market? And also, we want to have clear communication. That's our traditional tenet, right? When you have such a high level of uncertainty, what's the definition of a clear communication? Thanks.
Thank you very much, Libo. Now, Jacob, please.
Thank you. Everyone here spoke about heightened uncertainty. I think that, Jens, you started by referring to Galbraith 45 years ago, and this year is exactly the 100th anniversary of the classic book of Frank Knight on risk and uncertainty. And indeed, this distinction is critical in these days. In the normal situation, when we do not know the outcome of a situation, we still know how to compute the odds of a given outcome. But the other extreme, which Frank Knight introduced, is that we don't even know the information needed to compute the odds. And the feeling is that we are moving into, or have been moving into this area. I only want to alert against the instinctive reaction of saying that since we are moving from the world of the Knightian risk to the world of the Knightian uncertainty, we can throw the old textbooks away. There is a significant corpus that we will need when we get to the better world in which we can compute the odds. I want last remark to connect to the previous question. You spoke about, in a way critically also, about the dictum that when you go into a dark room, you should walk slow and not run. But this means that as we are going into darker and darker rooms, we will crawl and maybe even stay still. And there is a danger in this. So what should we do? I think that the first thing, we should go and turn on the light. Or take the flashlight. And this connects to the last remark. In our context, turn on the lights means the communication, explaining what we are going to do, and therefore remove the main obstacle for being told, don't do so quickly because you will surprise the markets. Exactly, don't surprise the markets and prepare the markets. Thank you.
Thank you very much, Jacob. So it seems that pretty much all the questions were for Jens. So please address them, and then I'll give half a minute to each of the panelists if they have an urgent thing to say.
Let us make the panelists work a bit, Agustín, and not burden all on me. But let me start with the communication point, which has, I think, been made by Lesetja also in a quite smart way. Because you highlighted that it's not only about how policy should react to uncertainty, but also how we should communicate around that. And there's, of course, the more technical solution to be very transparent and communicate about all the possible scenarios, which you can do. I think the more important point is the one that Lesetja made, and that I also tried to make in my speech, which is to focus on the more certain things. The commitment to price stability, the narrowness of the mandate. I think at the end, if you start communicating too much, it risks being more of a confusion than a help to guide people. So making clear that this is all about price stability, and central banks are there to deliver that at the end of the day. I think this would be my response my simple response to that question. In particular, if we're talking about nitrogen uncertainty, then all those scenarios are of no big use anyhow. Perhaps then jumping to the first question to Pierre, I think there might be some asymmetries also on the up, so to speak. And one which you didn't mention, which was an issue that was very close to my thinking all the time, was the risk of financial or fiscal dominance, which could also induce pressure on the central bank to change their reaction function, so to speak. But what I find and what I try to address in my speech a bit more was non-linearities in the behavior of agents. So I do believe that there's this region where not much happens. And the shocks that we experienced are so large and so persistent that they kind of brought us outside this comfort zone. And many things that we don't really understand do happen there. And that's another kind of uncertainty than the one we have been dealing with. And this is, I think, a very important point that many of the panelists have also been making. So on the concerted action, so to speak, of central banks, my response would be, I guess, that of the colleagues or the standard central bankers' response that you have a mandate, you have data that is kind of focusing on your mandate, and you have to deliver on that mandate. And you have to use fora like this one here to exchange on the externalities. But you have a national mandate.
Okay.
Brief answer to...
No, very good. Excellent. Well, you delivered right on time, almost. But let me give half a minute to Haruhiko if you want to add something. Or a little bit more. I mean, I can be generous.
Yes. As I said, the Japanese economy performed relatively well in the 2010s, growing per capita GDP growing by 1.3%, and during that period, employment, several million jobs were created, and unemployment rate declined to 2%. So labor market became very tight before the pandemic, but wages continue to be slow to rise. Even the economy grew and performed relatively well. Wages remained modest, and so that the inflation rate remained less than 1%, almost continuously. And now, because of energy price increase, our consumer price index, CPI excluding fresh food, reached 2.1% in April and May, almost wholly by international energy price increase. Because if you exclude the fresh food and energy, then CPI inflation is 0.8% or something like that. And we expect even 2% inflation rate may continue 12 months or so. But then in the next fiscal year, inflation rate will return to 1% or something like that. So unlike other economies, Japanese economy has not been much affected by the global inflationary trend, so that our monetary policy will continue to be accommodative, so that as Agustín wished to raise a question, but I think the whole situation probably may be the aftermath of 15-year deflation from 1998 through 2013. During that time, quite mild deflation, slightly less than half a percentage price decline on average every year, but quite persistent. And that deflation made probably Japanese firms as well as trade unions to become very cautious in raising prices and raising wages. So economy recovered and companies recorded high profit, and the labor market became quite tight, but wages didn't increase much and prices didn't increase much.
Excellent. Thank you very much. Very quick closing remarks, Pablo.
Maybe just one point related to what Jacob said. I mean, it's interesting to see that very often the mistakes that we do on real estimates of potential output growth or R star, etc., are due to the fact that we treat every observed data as a structural. Okay, so this means that 4 years later we realized that it was not a structural change. So we shouldn't have moved the potential output growth in parallel to observed data, and of course the mistake is done in the output gap that was estimated. I wanted to relate this to Jacob's comment because, well, there is always this temptation to say that this time is different, that everything is structural, that our models do not work. Well, maybe it's probably not also a very prudent approach to say so. What we have to know is what the assumptions and the limitations of our models are, and to make them explicit and to play with the assumptions in order to see what happens if things change, because of course they might change.
Thank you very much. Pablo, Lesetja.
Not much, just two things. One is that as we normalize policy, one of the issues that had been raised, which was fiscal dominance that we are going to have to take cognizance of and is going to pose serious communication challenges for us, is winning the treasuries of cheap money, because they have become addicted to the cheap money. And as we normalize policy, it is not going to take long for some politician to just say that the reason why there is now a problem with the fiscals is these ugly guys who are increasing interest rates. And I think that it is a very important point that we are going to have to take cognizance of. Secondly is that we are actually in a very interesting era. I think that, I don't know, but I think that I've seen this elsewhere, but at least I can talk for my country at the moment. We are having a public that is increasingly intolerant of high inflation. And it is something that central banks are going to have to watch, and we have got, if we are to retain our credibility, we have got to be seen to be acting decisively on inflation.
Thank you very much, Lesetja. Thomas, the final word.
Well, thank you, Agustín. Just to your question, Pierre, I think we should not underestimate the cost of deflation. So, and Haruhiko explained that quite well. Again, I think the experience from the Swiss situation is very interesting. So we were several times in negative inflation, but only very short, for a short period of time, maybe 12 months, maybe 15 months, but not much longer. And what you also observed is that low inflation, something between 0 and 2%, is not actually a big problem for the economy. On the contrary, the economy is adjusting quite well to that. And I think it's exactly your point that in a way, many live much better with low inflation than with high inflation. And Lesetja, as you said also before, so in the population, high inflation is much more problematic than something between 0 and 2%.
Thank you very much, Thomas, and thank you all, especially to Jens for a very inspiring lecture that certainly stimulated a lot of debate, and to our panel for great discussion. I also want to thank Guillermo for being with us, and all of you for attending. And I very much look forward to seeing many of you here in Basel at the next Per Jacobsson lecture in 2024. So with that, thank you very much, and I wish you all the best.